Welcome back to Money Pop. Gold and silver continue to chop around, even pulling back close to the support zones we have been tracking since late March and early April. That is around $4,300 an ounce for gold and $66 an ounce for silver. One thing is becoming abundantly clear. Analysis from Investing Pro suggests gold is coming into major support, pegged at $4,374 an ounce. That is very close to our number as we slowly run out of sellers in the fourth month since the major January pullback. This is important to note because as we move over to silver, analysis shows the importance of silver holding the $73 per ounce level to avoid a bigger breakdown to $66. What this is setting precious metals up for is an explosive move that could either massively squeeze the shorts, the bets against metals prices, causing a big move to the upside and an I missed the dip moment for many people, or admittedly a big move to the downside if we do not find buyers at the levels mentioned. With two very different short-term scenarios staring us in the face. In this video, we want to take a deep breath and look at the situation from a pragmatic point of view. We will discuss why waiting for the metals crash to go deeper is possibly the biggest risk you can be taking today. Then we will circle back to the topic of India, their higher import taxes on gold and silver, and some ways people in the United States, Europe, and India can legally avoid import and sales taxes on gold and silver while still benefiting from the remaining upside they offer. Jumping in. The bond market is getting major news coverage right now, with many people saying the dollar will continue to get stronger as yields, or interest rates on U.S. debt demanded by the market at bond auctions continue to go up. It is a nice story people can use to explain the recent weakness we have seen in gold and silver prices, but the numbers just do not add up. The increase on the 10-year Treasury yield so far this year, from the low to where it is now, is equal to about 2 Federal Reserve interest rate increases. It is up almost 10% from where it started the year, and despite being at 2023 levels, when the DXY was at 107, the dollar index remains below 100 today, up less than 1% on the year. The reason is a growing crisis of confidence in the US dollar and the United States' ability to keep inflation under control. This is creating a carbon copy repeat of what we saw when the US dollar was taken off the gold standard from 1971 to 1980. Where the DXY crashed despite the 10-year yield going from 6% to 11%, and gold went from $35 an ounce to more than $600. The only difference this time around is that it is not the United States going off the gold standard due to unsustainable spending habits. It is the rest of the world going off the US dollar standard for many reasons, including unsustainable spending habits. The reason to caution against completely waiting for a market crash before making your move on gold and silver is that not every crash is 2008 or the C-19 crash. I know those are the most recent crashes we have experienced, but both happened during what has arguably been a 40-year bull market for bonds. When we hit tough times, US debt was an easy and reliable thing to fall back on. Today, we are not in a bond bull market at all. So this assumption, mainly held by millennials and Gen Xers, that a crash in stocks must coincide with an immediate but temporary crash in metals prices, simply does not apply the same way it did during the bond bull market. What applies today is an old piece of boomer common wisdom that came from their experience in the 1970s, during the bear market in bonds, which started in 1973. That wisdom says a stock market crash is often accompanied by gold and silver going up. You can see that dynamic clearly. In the early days of the bear market for US bonds in 1973, the S&P 500 crashed by 50%, at which time the price of gold went up by 157% from $65 an ounce to $167 an ounce. This is not necessarily the new rule because we can still see a little more weakness in metals prices. But with extreme sincerity, it can happen. Metals can go up when the stock market declines if confidence in the dollar is low. This is not based on a theory or a hunch. It is based on something that actually happened. And if the weakness we are seeing in the bond market today turns into a complete collapse, the currencies that debt is denominated in will collapse with them, whether it is the Japanese yen, the Indian rupee, the Turkish lira, or even the US dollar. If that happens, you had better have some gold and silver. The alternative is a continued melt-up in the markets due to a massive printing party the Federal Reserve is already engaging in, which will also send metals to new all-time highs, even before a major stock market correction can happen. Now to the viewer question, a follow-up to a topic from Sunday's video. That is India's new tax on physical precious metals entering the country, which has made gold and silver in India more expensive to buy and will theoretically impact demand in one of the largest metals markets. Commenters offered their thoughts in ways Indian people will avoid paying the tax, including smuggling and buying ETFs. With the rupee on the ropes having lost 92% of its purchasing power versus the US dollar since 1971, and with analysis suggesting the pain is far from over, technicals only tell part of the story. Huge deficits and fears over imported inflation keep fundamental macro pressure on the rupee. It is only logical to assume Indians, looking to preserve their savings, will continue to turn to gold and silver, especially as the devaluing rupee puts gold up 232% over the past 5 years, versus a 154% gain when measured in US dollars over the same period. For silver, it is up 208%